One of the first to see what all that stimulus may be doing to our economy is Ruchir Sharma, Morgan Stanley Investment Management Chief Global Strategist and author of 10 Rules of Successful Nations, who says the health of our free enterprise system itself may be at issue.
I think the big issue here is this, David, which is that capitalism, I think, is being undermined when you keep on doing these kind of interventions. So therefore, what you see here is a zombification of capitalism in a way. And there's one statistic which highlights this. The number of zombie companies, let's say in the United States today, is 20%, which means 20% of all listed companies in the United States have not earned enough profit to cover their interest expense for 3 years in a row. This number in the 1980s was a mere 2%. So I think that this is the entire problem today with the way we think about stimulus and what the effects are. That the conventional wisdom and the consensus is that as long as you don't have inflation, there is really no downside to having constant intervention in the markets and to having all this stimulus, because people are trained to think that inflation is what really should come through as a negative consequence. And the point that I've been making is that there are many insidious consequences of this constant intervention and always supporting the markets. And one of them is the fact that you have a rise in zombie companies, which is why I think that productivity growth around the world and including in the United States has been so weak over the last few years.
So that's a critical point, productivity, ultimately, in terms of really healthy growth. Have we essentially suspended creative destruction, Schumpeter's creative destruction? Because I think a lot of increase in productivity has thought to become from creative destruction.
Yeah, because we're seeing it from both sides. Look at what's going on, which is that the number of new startups, that's declining. The number of zombie companies is going up. And as far as existing companies are concerned, we have rarely had so much monopoly power as we have now. So this combination tells you that there's something wrong with creative destruction. Now, not all is lost, but this is being undermined over time. And I think that these consequences of stimulus and nobody is too small or even big to fail, I think that this is what the consequences are, which are less appreciated, because most people appreciate the consequences when there's an apparent crisis or if there's some big upsurge in inflation. But what's happening beneath the hood, when you look at productivity and why is productivity declining, I think that these reasons are being dramatically underestimated.
Connect up monopoly power on the one hand with what you're describing here with keeping alive companies that otherwise might fail. Why does the one lead to the other? Is it because money is so cheap so people could afford to borrow money to buy other companies, or is it something else?
Absolutely. You've hit the nail on the head, which is that a lot of academic work here has been done to show that the larger companies get larger because they have access to cheap finance and they're able to make acquisitions. And at the other end of the spectrum, you have zombie companies that they're able to stay alive because they keep getting easy finance. So what gets squeezed are people in the middle and firms in the middle. And also it keeps out new startups from coming. So I do think that eventually creative destruction comes back, but it gets delayed a lot because of this process. And this undermines productivity, which at the end is the key to sustainable growth. You can do the stimulus, you'll get a big sugar rush. But the key to sustainable growth is productivity, and there just isn't enough focus on that.
What's the exit strategy? I mean, in 2008, we thought we really needed to have a lot of stimulus because we really had a huge financial crisis. And now, 2020, we have the pandemic. It may be a good and sufficient reason to have the stimulus, but is there an exit strategy? And let me put it a different way. Given how much people particularly companies, have leveraged up, are we essentially too indebted to fail at this point instead of too big to fail?
Yes, that's very true. So there is no real exit strategy, because what the policymakers are doing just now is that they're going further down the road. Even though an economic recovery has begun, unemployment rates are falling, we are still talking about how to do more stimulus because interest rates are so low.
Certainly we're seeing equities fully valued, maybe more than fully valued. What about some of the one-offs, things like cryptocurrencies? Is that being reflected in Bitcoin? Is there just so much money sloshing around the system because of monetary and fiscal support that we're going to get the Bitcoins of this world, even if there are no fundamentals that support it?
Yeah, there's one statistic which really sticks out for me. more than 20% of all the dollars that are in circulation in the world today were printed just last year. That's the kind of monetary reflation that we have done. 20% of all the dollars in circulation were printed just last year. So now there's bound to be some consequence of that. And that's really what we're seeing as far as the Bitcoin is concerned, that there are people who are growing distrust, growing more wary of this fiat system. And so therefore they're flocking to Bitcoin because the one advantage that Bitcoin has is that its supply is finite. And so therefore we are seeing this rush to Bitcoin because there's such a huge supply of dollars. Other central banks are also following suit. And on the other hand, you have a finite supply of Bitcoin. And a lot of the millennials in particular understand that much better in terms of the Bitcoin market than this do, let's say, gold. So therefore, Bitcoin, I think, has emerged as the new gold, the appeal of a new store of value as a consequence of this incredible monetary reflation that we have seen from central banks.
So Ruchir, we've been talking about the massive infusion of liquidity in the market, both fiscal and monetary. Let me ask you the provocative question, and that is, given where we are, the role of the government, and that's not just the United States, as you've pointed out, it's also true in Europe, it's true in Japan, the role of the government in the economy, which is increasing, are we in danger of turning into a form of China? We've criticized China for many years for their state-owned enterprise, the extent to which their state control of the economy. Are we in danger of turning into a version of that?
You know, there could be some convergence, but to China's credit, there's one thing I'll say, that China's success over the last 40 years has been that the role of the state has systematically gone down in China. So yeah, you have the state in the background, but the role of the private sector in China has increased a lot. What is it that helped China negotiate this incredible debt bubble that they had built over the last few years? It's the rise of the tech giants in China, all in the private sector. So yeah, I think that the government's there lurking in the background, but I think that we don't quite appreciate how much the private sector in China has contributed to the growth model. But yeah, I think you may have a point here, which is that China started from a very state-heavy model, and that has gone down over time, even though the state is still there. But in the Western world, as you're saying, that we started from a very private sector-oriented model with more and more government intervention that we are seeing there. So there could be a convergence here in the economic models we have in China and we have in the Western world.